the incomplete records. So August 2021, that was the question that we're doing. So August 2021, we said we have what we call incomplete records. And maybe we just repeat what we, so you said we can repeat that question, isn't it? So working number one, I had forgotten to tell you the working number one, we are doing incomplete record. Incomplete records. And we are doing CPA August 2021, August 2021, question number 2. We're doing August 2021, question number 2. August 2021, question number 2. So now, okay, although we had skipped this one, we will have worked it out. The first thing is when you have the incomplete record, most of the time, so the question reads Alpha Omega operator retail business. He has not employed a qualified accountant, therefore has not maintained proper accounting records. The following information was extracted from his books for the year ended at 1st March 2020. So we have the information extracted. Then we have additional info. The following information took place during the year ended at 1st March 2021. Number one, sales and purchases on credit amounted to 8,320,000 and 7,600,000 respectively. And number two, the following transactions were carried out through the bank account. You have been given the transactions. And number three, the business operates a gross profit margin of 25%. Number four, accrued electricity as at the 1st March 2021 amounted to 76,000. Number five, bad debts of 80,000 were written off during the year ended at 1st March 2021. The allowance for doubtful debts is to be maintained at 5% of the outstanding accounts receivable at the end of year. Number six, during the year ended at 1st March 2021, the business received discount of 160,000 and allowed discount of 280,000 shillings. Number seven, loan interest paid was for half a year up to 30th September 2020. Number eight, the business depreciates motor vehicle at 20% per annum on reducing balance basis. A full year's depreciation is provided on motor vehicle acquired in the course of the year, and no depreciation is provided on motor vehicle disposed of in the course of the year. Number nine, the motor vehicle disposed of during the year ended at 1st March 2021 had been purchased at 1 million and had an accumulated depreciation of 488,000 shillings at the time of disposal. Number 10, furniture is depreciated at the rate of 10% per annum on cost and is prorated to the period used in the year. The additional furniture was purchased on 1st October 2020, while the cost of furniture held on that 1st March 2020 was 1.6 million shillings. Required a statement of profit or loss for the year ended at 1st March 2021, 12 marks, and B, statement of financial position as at 1st March 2021, 8 marks. So this is an example of incomplete record. We're just starting. So we said working number one, you can start with what we call the statement of affairs. Statement of affairs. So incomplete record is where the business is not maintaining proper records of accounts, and therefore the rule of double entry is not being observed. So the statement of affairs is to assist you get the capital of that particular business. Is to assist you get that the capital of that business. So how do you get the statement? How do you get the capital? You identify assets at the beginning of the year, not during the year, at the beginning of the year, and you deduct what? Asset at the beginning of the year, and then you deduct what? You deduct liabilities. So you identify assets at the beginning of the year. Assets at the beginning of the year. You identify assets at the beginning of the year. So the following information, the beginning statement. So there is where we have the information. The financial year runs from 1st April 2020 to 31st March 2021. So this is their current financial year. So those items that were there on 30th March 2020 were there at the beginning of April, 1st April 2020, isn't it? So it is from those items that we can be able to get the assets. So we identify the assets. So assets, we have accounts receivable there, accounts receivable, or we call it debtors. account receivable, the value is 2,000, so you write there 2,000. And then we have bank overdraft, that is a liability. Accounts payable is a liability. Electricity expenses accrued, that is a liability. 10% bank loan, that is a liability. Allowance for doubtful debts, that is a liability. Then we have freehold property. Freehold property, that is an asset. 2,400. We have motor vehicle. Motor vehicle, 3,000. And then we have furniture and fittings. Furniture and fittings, 960. Then we have the inventory. Inventory, that is 1,560. So those are the only assets at the beginning of the period. And then we get the totals here. And then we list the liabilities. Liabilities at the beginning of the year. Liabilities at the beginning of the year. So we have bank overdraft. Bank overdraft. That is a liability, 240. And then we have accounts payable. Accounts payable, that is 1,520. And then we have accrued electricity. Accrued electricity, that is 60. And then we have bank loan, that is a liability. Bank loan, 2,400. Allowance for bad debts. Allowance for bad debts. Allowance for bad debts, 100. So those are the only liabilities. So we add. Can we add? Anyone who is adding? Statement of affairs. Can we add very fast? Sorry? 99? 9920. And then the other one? 9920. The other one? $43.20. So this one is $43.20. And then we take the difference. That one will be the capital. What is the difference? So the capital will be 5,600. And then we said you have to open these accounts. You have to open the debtors account. You have to open the debtors account. So you have to open the debtors account. You start by the balance brought down, the opening balance of the debtors at the beginning of the year. So the debtors are the account receivables. Another name for debtors is account receivable. So the opening balance is 2,000. 2,000. That is the opening balance. And then we go through the other information. We identify items that are posted to this account. Already we know those items through the control account. We know the items that are posted here, but in just a reminder, on the debit side of this account, this is a debit side. We normally post the item that increases the value of debtors. On this side, we post the item that increases the value of debtors. So we identify those items. Already we know those items. So we go note by note, trying to see those items. Note number one, we have credit sales, sales and purchases on credit. So when you sell on credit, you credit your sales account and you debit debtors. So here we're going to write here credit sales. Credit sales. It is there in note number one. It is 8320. So you write here 8320. So that is, and then number two, the items, the transaction that took place through the bank. So we have collection from the account receivable. So they paid through the bank. Debtors are those customers we sold on credit. So when they pay through the bank, it reduces their balance. So you write here bank. So they paid 7560 in note number two. This is note number two, 7560. We credit the account. We go to note number 3. Note number 3 is talking about gross profit margin. So it does not have any relationship with the debtors account. So is note number 4, which is talking about electricity. Note number 5 has bad debts. Bad debts, when you have bad debts, bad debts are those debtors that we have already identified and classified as uncollectible. So those ones, you credit the debtors, you eliminate them from the books. So you write here bad debts, they are not going to pay. So you write here bad debts. So the value of bad debts is 80. Remember, we have deleted the 0. So you write here 80. So that one you credit. And then number 6, during the year ended 31st March 20, the business received discount of 160 and allowed discount of, so we have discount allowed. So we write here discount allowed. So discount allowed affect this account. The value is 280. It is note number 6. So right here 280. Note number 7 is talking about loan. So it doesn't have anything that affects the debtors account. Note number 8, it is talking about depreciation. Note number 9, it is talking about disposal of motor vehicle. Note number 10 is talking about furniture. So these are the only items in that account. And so these are the only items in the additional information that are posted to that account. Remember yesterday, I told you the essence of this account is to assist you either to get the closing balance of the debtors, balance carried down here. So that one would be if the question has the figure for sales and the amount of money received from the debtors. If the question gives you a value of the credit sales, at the same time it gives you the amount of money received from the debtors, then the balancing figure here is that they want you to get the closing balance of debtors. If it gives you the closing balance of debtors and the amount received from the debtors, then it needs you to find the credit sales. So you can either use this account to get the closing balance of debtors, or to get the credit sales, or to get the amount of money received from the debtors. And that one, it depends on what you've been given. So your work is to post whatever it is that you're given. And what is missing is what the question wants you to find. So in this one, we need to find the closing balance of debtors. How much will that be? The closing balance. You add this one, balance carried down will be how much? Sorry? The closing balance. When you add this one, subtract this one, you get 10,320. 20? So 2,400, isn't it? Total will be how much? 10? So this is the closing, so in other words, the closing balance of debtors is 2,400. That is working number 2. We go to working number 3. You open the creditors account here. This is the creditors account. You open the creditors account. So you take the balance board down, it will be on the credit side. Why? Because creditors are liability. Creditors are a liability to the business. The abilities have credit balances. So another name for creditors is accounts payable. The opening balance is 1520. Can you see it? We have not been given the closing balance. Again, we go through the information provided. We identify items that are normally posted to this account. Additional information number 1. Can we get it from the other side? Additional information number 1. Additional information number 1. We have the credit purchases. So when you make credit purchases, the double entry is you debit your purchases and you credit your creditors or payables. So here you write your credit purchases. The value is 7,600. Additional information number 1. Additional information number 1. Umeiona? We go to additional information number 2. We're identifying items that are posted to this account. Additional information number 2, we have payments. Payments to accounts payable. So when you make payments to accounts payable or creditors, you credit your bank account and you debit the account. So they are receiving. So you debit here, you write your bank. So they are receiving 7760. We continue like that, identifying more other items. Number 3 does not have any item. Number 3 is talking about gross profit margin. We go to number 4, we have accrued electricity. Nothing in that account that is posted to that account. Note number 5 is talking about bad debts. It has nothing to do with the creditors. Note number 6, we have discount received. So we write here discount received. So when you receive discount from suppliers, the double entry is you debit the account and you credit discount received. That is an income to the business. So the credit here is 160. That is in additional information number 6. Number 7 is talking about interest on loan, which has nothing to do with the creditors also. Number 8, the same thing. It is talking about depreciation. Number 9 is talking about disposal and furniture. So these are the only items that are posted to this account in this question. So the same way, so this account is to assist us either get the value of credit purchases, or to get the amount of money that is paid to the suppliers, or get the closing balance. So every time the question gives you the amount of money that is paid to suppliers and the credit purchases, then the closing, the value that account will assist you to get is the closing balance of the creditors. Every time you see these two figures, bank and credit purchases, then they want you to get the closing balance. Every time you see the closing balances and this, they want you to get the credit purchases. So can we get it very fast? So we adding this one, we are adding this one. Can I use this one? This is your calculator. It has no, you should not write. I'll give you time to write, but you should follow, because these questions are they are very fertile ground for examination. So here you get it is 7920 here, and then you minus 1520 minus 7,600. So you get the closing balance here is 1,279.20. And then working number 4. In working number 4, you also be required to open. You're okay. So working number 4, you'll be required to open. Yes. You're getting a different answer. You're getting a different. Oh, balance should be, oh, sorry. Balance carried down, you're right. It should be this side. It is 1,200, yeah? But it is 1,200, isn't it? Balance carried down is 1,200 this side. Sorry, you are right. Balance carried down is on this side. Sorry for that. But what is the total? 81? Oh, 9120. Yeah, you are right. So that is the balance carried down is on this side. Correct. Another account that you must open. These 3 accounts are necessary. This one and this and this. And then you must open the bank. You open the bank account. The bank account. So the bank account, first of all, you pick the opening balance from the opening values. So we have the balance brought down. It's an overdraft. An overdraft will be having, the balance will be on the credit side of the bank account. So the bank overdraft is 240. So you will post here 240. And then note number 2, we are being told the transaction that took place during the year through the bank. So the bank electricity expenses. So it means they paid electricity through they wrote a check in favor of electricity. So when you pay a check from your bank account, then it means you credit bank and you debit electricity. So we're going to write here electricity. Electricity, the amount is 260. They also paid general expenses. So you write here general expenses. General expenses, the amount is 140. And then they paid interest on loan. Interest on loan, they paid how much? 120. And then there was also drawing. There's drawings by the owner of cash. Drawings of how much? 240. And then they also repaid loan. How much? 400. And then collection from receivables. Receivables paid the business. When the receivable pays, you credit them, and then you write here receivables or debtors, which is 7560. So that one will be a debit item. Then they also sold one of their motor vehicles. So when they sell a motor vehicle, you credit disposal and you debit here. So you write here disposal. You write here disposal, which is 480. Then they also paid salaries and wages. So you write here salaries and wages. Salaries and wages. How much is it? 640. Then they also bought furniture. So you write here furniture. 800. So you write there 800. And then they also paid creditors or account payables. Creditors, they paid them 7760. And then they had cash sales. Cash. So you have your sales, you write your sales, which is 2880. Then they also made purchases. Purchases, how much is it? 960. So those are the transactions. So we can be able to get the balance that was there in the bank. So we balance off this account to know the balance that is there in the bank at the end of the period. So we compare the items on this, we add, we aggregate totals here. We also aggregate to this side and we take the difference. We take the difference. So this one was 240 plus 260 plus 140 plus 120 plus 240 plus 400 plus 640 plus 800 plus 7760 plus 960. So the credit side is 11,560, and the debit side is 7,560 plus 480 plus 2880. So 10. So this side is great. It is a greater side. 11,560 minus 11,560. So 640. So the closing balance is at bank overdraft of 640. It is from the bank account that we'll be able to get the expenses paid during the period. So all the expenses will be credited here and you will debit the income statement. That is the reason why we need this account. Besides, you also need the closing balance that you're going to use it as a balance in the statement of financial position. So that is working number 3, very important. So we can finish up the workings and maybe we prepare the income statement. So we had the markup. Markup is to assist us mostly get the closing stock when it is there, margin. So when you apply margin, that is working number 5, margin, we have been given the margin as 25%. So when you apply margin to sales, you get the gross profit. So our gross profit is going to be 25 over 100 times the sales value. So where is the sales value? The sales value, you take the credit sales, which is 8320, as we had said yesterday, this one, plus the cash sales, which is 2880, plus 2880. So when you do that one, you get what we call gross profit. Can we do that one? Margin. So you add 8320 plus 2880, and then you take times 0.25. What do you get? Huh? How much you get? 2800. So our gross profit is 2800. Is it so? Huh? So GP, we all know gross profit is equals to sales minus cost of sales, isn't it? So we have our gross profit, which is 2800. Our sales figure, when you add these two figures, what do you get? 8320 plus 2880. So our sales is 11,200 minus cost of sales, which you don't have. So the cost of sales will come this side and becomes positive 11,200, and our GP will cross the other side and becomes negative. So our cost of sales is how much? Our cost of sales is how much? So our cost of sales is 8,400. We all know how to get the cost of sales is equals to opening stock plus purchases minus closing stock. That is the formula for getting the cost of sales. So we have 8,400, that is our cost of sales. Opening stock we had been given, it is 1560. And then we can be able to get the value of purchases. The value of purchases, we have credit purchases, 7,600 plus cash purchases, which is 960. So add 7,600 plus 960. This one will give us the value of purchases. Anyone who has done that? 960 plus 7,600. So we are adding 960 plus 7,600. Well, how much do you get? Huh? So it is a 560, isn't it? 560 minus cost closing stock. Closing stock is not there. So closing stock will cross the other side and becomes positive. Closing stock is equals to 1560 plus 8560 minus 8400. What do you get? What do you get? So you get 17. During the year, the original price was 1 million. Are we together? And it had accumulated depreciation of how much? 488. So it had depreciated by 488. So now by the time it is being sold, this is the net book value, the cost minus accumulated depreciation. So what is the net book value? 1,000 minus, which is 500 and, so the 512, that is, and then you compare with the amount of money that was received for the sale. So this is bank. So this one was sold for how much? For it, isn't it? This is the value which the business has attached to the motor vehicle that was sold. So that to them, that motor vehicle was valued at 512. But it was able to fetch 480. It realized 480. So it realized less than the book value. So the difference is how much? The difference is how much? 32. So that one will be a loss. You see, it brought money that is less than the value, isn't it? This is the value according to their books. But this is what it was sold for. So it was sold for at a price that is lesser than the value. So that is a loss on disposal. So that is a loss on disposal. So those are the workings that you can do. Those are the workings that you can do outside the main statement. Although we can do others because we still have space here, we can even do number 7. But anyway, you write those ones and then we do the income statement. Write very fast. Write very fast so that we can do the income statement, the final statement. In case you have a question, you can ask. In case you have a question, you can ask. So we can make our income statement here. So you can write here alpha and omega. Alpha and omega income statement for the year ended 31st March 2021. So here we can have 2 columns, shillings and thousands, and here 2 columns, shillings and thousands. So we have our figure for sales. We have our sales figure. Our sales figure was how much? 11,200, isn't it? So this one was 83. It was 83.20 plus 28.80. So that is the figure for sales, which gives us how much? 11,200. Then we less cost of sales. Cost of sales. So we start with the opening stock. We start with the opening stock or opening inventory. Opening stock was 1560. Is it so? 1560. And then we add purchases. What was the value for purchases? 85.60. Where is this value? This value was here, isn't it? It was 7,600 plus 960. And then we less the closing stock, which is 1720. So you less here. So what do you get? Unapata ngapi? Unapata 2,400. This is 2,800. Ilikuwa ngapi? 1560 plus 8560 minus 1720. That is 8,400, isn't it? Then we get the gross profit here. 11,200 minus this, and which is 2,800. So another way you can be able to get this closing stock without having to go through this lengthy procedure, once you have the margin and you have your sales value. So margin, we know it is 25%, isn't it? So you just come here and apply that 0.25, you multiply by 11,200. 11,200, isn't it? So that one will get 2,800, isn't it? So 2,800 here. And then you'll have your figure here. 28, you have 2,800. If you have 2,800. And then now we have 1560. 1560 plus 8560. That one will give us how much? So this one we had been given, this one was there given. This one we had already determined it, purchases, isn't it? So the figure that was missing here was 1720, isn't it? When you have it is now, you see, when you have sales, we know how to get the GP. GP, we said it is sales minus cost of sales, isn't it? So already here we have the sales figure, which is 11,200 minus cost of sales and 2,800. So we can be able to get the value of cost of sales, isn't it? So cost of sales will be 11,200. This one minus 2,800. So this will give us 8,400. Already we have got this one through application of 25% of 11,200. Now, if you take 1560 plus 8560 minus 8,400, isn't it? You get 1720. I think that one is easier, isn't it? You get 1720 without having to go through that lengthy procedure. Sijui kama tumeelewana. So hapo utakuja tu uchukue 25% of sales, you get 2,800, isn't it? Then you get this one minus this. You get, then you add this plus this, isn't it? Minus isn't it? And then you get 1720. So we come here and list our expenses. We add discount received. We had discount received. We had discount received. This discount received is an additional income of how much? 160. It is still there, 160. So you add there. Then here you come here and list your expenses. You list your expenses. So the first expenditure you have, here it is where we get we have electricity. We have electricity is an expense. So you write here electricity. So you take the amount of money that is paid for electricity, which is 260, 200, and then we have accrued electricity at the beginning of the year. Accrued electricity at the beginning of the year, which was 60. Accrued electricity at the beginning of the year was how much? 60. Accrue at the beginning, you deduct. Accrue at the beginning, you deduct. At the end, you add, which is 76. What do you do that? Why do you adjust like that? If you have any expenditure that you have an arrears, if you are paying for that expense, first of all, you must pay for the arrears. You must clear the. So if they give you an arrears at the beginning of the year, it means that this amount that is paid is inclusive of that arrears. And remember, the arrears is not for the current period. That is why we are deducting. So this amount of 260 that is paid through bank is inclusive of 60, the amount that was supposed to have been cleared last period. That is why we are deducting. And then this 76 is an amount that is supposed to be paid this year, but it's not yet paid. So we must recognize it in the current year using the accrual concept of accounting. That is why we are adding this one. So that is how we adjust for accruals at the beginning and at the end. So what do you get? 260, 236. So here it is 270. So you write here 276 to Melawana. The next expense here is general expenses. So you write here general expenses. General expenses. So general expenses is 140. So you write here 140. This one has no any adjustments. Then we have interest on loan. Interest on loan. So how do you determine the interest on loan, the total interest payable? This business had a loan of 2,400,000 at the beginning of the year. This was the loan amount they had. Is it so? How do I know that they had that particular loan? We have been given the starting information. So we've been given 2 million bank loan. And they have written there 10% bank loan. 10% bank loan. What it means is that they have a loan of 2,400,000. And this loan is attracting an interest of how much? 10%. Okay. So now the total interest they're supposed to pay, it is 10% times 2,400,000, isn't it? Times 6 out of 12. After 6 months, they paid something to reduce the loan value, isn't it? They paid 400 to reduce the loan amount. So the interest that is going to be paid for the last 6 months of the year will not be the same as from the first 6 months of the year. So the next 6 months will be 10 out of 100 times 2,400 minus 400 times 6 out of 12. So you come out to Nelewana. After 6 months, they reduce the loan value by 400. Therefore, the interest that now will be paid in the last 6 months will not be the same as the first six months. So now this one will be how much? 10, 100 times 24, 6 out of 12. So this is 0.1 times 2,400 times 0.5, isn't it? So this is 120. This is the interest that was paid for the first 6 months. And then we have 0.1 times 2,000 times 0.5. So that is 100. So the total interest that you're supposed to pay in that year is 200, and this is the interest that is supposed to be paid in that year. Tumeelewana? They have only paid 120. They have paid. This is what they have paid. So you come here and write 120, the one that is paid, and we know that 100 is still owing or accruing. We add that one. So we come and get 220. So this 100 will be taken to the statement of financial position as a liability. Sijui kama nimeenda haraka kama mmeelewa ama nirudie. Watu walikuwa na loan ya 2,400,000 mwaka ikianza, si ndio? Na hiyo loan ukiwa nayo ina attract interest, sio ni kawaida. So interest walikuwa wanafaa walipe kwa hiyo loan ni 10%. Lakini after 6 months walipunguza hiyo deni ya 2,400,000, walilipa 400,000 kupunguza hiyo deni. Umeelewana? So ile interest watalipa for the last 6 months ya hiyo mwaka itakuwa less than ile ya first 6 months ya mwaka ikianza. Hii 2,400,000 it was there from the beginning of the year up to the September. So the year began on April, September, and then they reduced it by 400,000. I think that one is done. It is clear. We go to the next expenditure. It is through the bank account that you can be able to find out the expenses paid when you're doing incomplete record. So this one, we are already done. This one is not an expenditure. This is a liability, and this is salaries and wages. That is an expense. So we write there salaries and wages. So you write there salaries and wages. Salaries and wages. How much is it? 640. So you write there 640. Furniture, that is an asset. And then creditors, purchases. Okay, we also had bad dates. We had bad dates of how much? 80. That is an expense, isn't it? Is it so? Then we also had discount allowed. That is also an expense. Discount allowed. It was 280. Okay. Tumeelewana. And then note number, they had, when you read note number what? Note number 5. Bad debts of 80,000 were written off during the year ended at 1st March 2021. The allowance for doubtful dates is to be maintained at 5%. So we have allowance for doubtful dates, allowance for bad dates. After determining the closing balance of their debtors, these are the debtors they expect to pay. This is 2,400. Those are the debtors that are expected to pay during the year. But besides, they're estimating that others will not pay. Just an estimation. It doesn't mean necessarily that they will not pay. So they want to stand in for them. How do they stand in for them? So they are saying 5% of that amount is going to be taken from the income statement to stand in for those ones that are likely not to. So that is in line with what we call the prudence concept. You don't need to overestimate your incomes, your profits, while you still have debtors outside there. And those debtors, some of them will not comply. Others will fail to pay. So you need to provide for them. So stand in for them. So they're estimating out of the total balance of the debtors of 2,400,000, 5% of them will not pay. So the business is standing in for them. 2 million. So 5% of 2,500,000 is how much? 0. 120. So remember we said provision. It is that we have provided. We check whether we had provided before. So we either adjust it upwardly or downwardly. So when you check the opening balance, they had already provided 100 before in the previous period, isn't it? So they had a provision of 100. So they are only increasing to 120, isn't it? So there will be an increase in provision of how much? Increase in provision for bad deeds. So that one will be 120 minus 100. That is 20. We own, huh? Uko sawa? So tulisema hapa adjustment ya provisions. We did adjustments to the final accounts, isn't it? And the one of the adjustment we talked about is provision for doubtful dates. We said out of experience, not all debtors pay. So when we are in business for a while, we are able to estimate the value of debtors that are likely not to pay. So we estimate and then we reduce our profit by that estimate. So now, according to this business, they're estimating the total value of debtors. 5% will not pay. So they want to stand in for them. So that 5% is 120. But besides, they had done some provision beside in the previous years. So when you're doing it for the first time, you debit your profit and loss account and you credit provision for doubtful debts. In the subsequent year, you adjust, either you increase or reduce. So they're increasing. Already they have 100 in that account and they want to make it to be 20. So where is this 20 going to come from? The 20 is going to come from the income statement, from the profit they've generated that year. So it's going to be treated as an expense. So that is, then we have depreciation. We have depreciation here. So we have depreciation on motor vehicle. Motor vehicle, it is 20% on reduced balance, 20%. So it's going to be, they had a balance of 3,000. 3,000 minus the one that was sold, 512. 512. So this was the net book value at the beginning of the year. And in this balance, we have this one that was sold, 512. It is captured in this opening balance. And this one is sold. So we eliminate it so that we calculate on the remaining balance. It is like this. So the balance brought down. This is motor vehicle account. The balance brought down was 3,000. And then there was disposal. Disposal was 512. So you eliminate. Then now the remaining balance is what you calculate depreciation on. We did not have any extra additional. We did not buy, there was no additional motor vehicle through purchase. So that one will give you how much? $3,000 minus 512 times 20%. How much is that? Sorry? So this one will be 497.6. And then we have furniture. Furniture, they're depreciating, and that is number 10. Furniture is depreciated at a rate of 10% per annum on cost and is prorated to the period used in the year. So furniture, it is depreciation of furniture. So they are depreciating furniture at 10% on cost on pro rata basis. Pro rata means according to the time used during the year. According to the time used during the year. So we have this furniture, we have the balance brought down. The one that was there at the beginning of the year, which was used throughout the year, the cost was 1.6 million. So it will be 10 over 100 times 1,600,000. This one is 12 out of 12. It was used for 12 months. And then another one, the new one that was acquired. The new one that was acquired, we have been told when it was bought. The additional furniture was purchased on 1st October 2020. This 800, the one that is being indicated in the bank, it was purchased on 1st October 2020. So from October, November, December, January, February, March. So the year ends in March, at the end of March. So those are 6 months. So this other new one that was acquired during the year was used for only 6 months. So it's going to be 10 over 100 times 800 times 6 out of 12. That is what it means by pro rata. This one was there at the beginning of the year. Although the opening balance, we have been given the net book value, but they have also given us the cost so that we're able to calculate depreciation. So can we do it? What do we get? So balance brought down 100 times 1,600, 12 out of 12. How much do you get? $160 total. This one, 160, and this other one, 40 total. So 200 depreciation here, furniture and fittings. It is 200. So you write there 200. 200. Then we have loss on disposal. Loss on disposal, which was 32. So this is an expense. So I believe those are the only expenses in this question, unless there's another one that you're forgetting, which you can remind me. So can we add all this? We add it very fast and accurately. This is one of the easiest questions. And the good news is the examiner is fond of it. Even last sitting, it was there. And it doesn't mean that because it was there last sitting, it cannot appear again. They know that some students are afraid of it, while it is the easiest. The examiner knows the psychology of students. So how much you get? Excuse me. Umepata ngapi? 23.6. And then now when you get the net profit, $574.4. So that is the net profit there. That is the net profit. Then now we write here alpha. We write here alpha and omega. Alpha and omega statement of financial position as at 31st March 2021. And then you underline here. So we have non-current assets here. Non-current assets. You have a different figure. So these are shillings and thousands. So we have non-current assets. We start with the freehold property. Freehold property. This one had no adjustment at all. This one had no adjustment at all. So we kept it the way it was, 2,400,000. No depreciation, no additional. Then we have motor vehicle. Motor vehicle, you take this 3,000 minus 512, the one that was sold, and then minus 497.6. This is the balance, the net book value at the beginning, minus what was sold, the net book value, minus the depreciation. So what is the value here? And then we have furniture and fittings. Furniture and fittings. Furniture and fittings, you take the opening balance. The opening balance was 960. 960 plus what was acquired, 800, minus depreciation, which is 200. I'm taking the net book value plus this one, minus 200. So what do you get? You're not doing computer, you're writing. You take the first one, what are you getting? 1990. And the other one? 1560. 1560, like that. So those are the only non-current assets. And then here we come here and list the current assets. We list the current assets. So we start with the closing inventory. The closing inventory is how much? 1720. Then we have account receivables or debtors. So we had the closing balance of 240 minus what was the provision for depreciation? The closing balance is provision for, it was 120. So you minus 120. Always you less provision. Yes. Motor vehicle is how much? Sorry? 1990.4, not 5. So they're saying this is 0.4. 2,400 minus 120. 2,400 minus 120, very fast. 22, 2280. Then here we had prepaid what? Do you have any prepayment? Accrued. Any other asset apart from that one? So we had bank. That one is not. The bank is a liability. I think those are the only assets. I think so. The question. Yeah. So can we add? Can we get the total here? These are the only assets. We get the total assets here. We get the total assets. Can we add all of us? If some students don't participate in addition during classwork, so when the exams comes, they forget their calculators at home. That is the experience I get those students who don't participate. 4,000 from here to there, it's 4,000. All from here. It is more than 4,000, isn't it? 99, 50.4, isn't it? Then here we write here capital and liabilities. Capital and liabilities. So we had got the value of capital was how much? 5,600. You remember? Then you add net profit. You add net profit. The net profit was 574.4. Then you less drawings. Drawings is there in the bank account. Drawings is there in the bank account. Drawings was how much? 240. So you less 240 here. Then you write non-current liabilities. Non-current liabilities. Non-current liabilities. So we have bank loan. So we have bank loan. It was 2,400 and they repaid 400. So it is 2,000. Then here we have current liabilities. We have current liabilities. Current liabilities, we have accounts payable or creditors. Accounts payable, the balance was 1,200. Then we have accrued electricity. Accrued electricity, the balance was 76, the closing balance of accruals, that one is. Then we have accrued interest. Accrued interest, it was 100, if you remember. Then we have bank overdraft. Bank overdraft, it was 640. Is it so? Can we add those ones and see? 1950. 19. 9950.4. So it is agreeing, isn't it? So that is how it is done. Can you do it very fast so that we can do another question? But before we do that, in case you have a question that you feel we should try to see, sawa, andika hiyo. May 2016 question number 3. 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 So the question reads, Samson Kimwatu operates a wholesale and a rated business. He does not maintain proper books of account. The following balances were extracted from his records as at 1st March 2015 and 1st March 2016. So you're beginning with the opening balances there at the beginning and the end. Additional information number 1, on 1st June 2015, the freehold land was revalued upward by 2 million. Number 2, during the year ended 1st March 2016, total purchases amounted to 126.6 million, and total sales amounted to 180 million, all of which were on credit. Number 3, discount allowed and discount received amounted to 480,000 and 450,000 respectively. Number 4, a debtor owing 120,000 was declared bankrupt during the year. Hence, the amount due from him was written off. Number 5, Samson Kimwatu makes a uniform gross profit margin to cost of sales of 3 out of 7 every year. So number 6, during the year, Samson Kimwatu purchased a new equipment at a cost of 300,000 and paid by check. Number 7, the following expenses were paid by check during the year: interest on loan 450, salaries of staff 18,105, and rates, insurance, power 11,640. Number 8, on 30 September 2015, Samson Kimwatu repaid part of his loan by issuing a check of 3 million. And number 9, Samson Kimwatu did not maintain records of cash withdrawn from the bank for personal use. Hence, any deficit in the bank account is due to personal drawings. A required income statement, income statement of the year ended at 1st March 2016, 12 marks, a statement of financial position at that. So this is another good question. I hope you've written, isn't it? So we are doing incomplete record, and the question is May 2016, remember? May 2016, question number 3. So we start with the statement of affairs. Statement of affairs. Statement of affairs. I think we can go together, isn't it? Because of time. So write the statement of affairs. I'll only allow it to write as we write. So we identify asset at the beginning of the year. Asset at the beginning of the year. So we can write here shillings and thousands. Shillings and thousands. So we have furniture and fittings. Furniture, that is an asset. Furniture and fittings. The total value for furniture and fittings, how much? 1,200 at the beginning of the year. So the year begins on 1st April 2015, sorry. And it ends at 1st March. We have motor vehicles. Motor vehicle, that is an asset. How much is it? 3,000. We have what? We have equipment. Equipment, that is an asset. How much is it? 2,000. And then we have freehold. Freehold land. How much is it? 6,000. And then we have inventory. How much is the value of inventory? 800. Then we have trade receivables. Trade receivables. What is the balance? 2,000. And then we have prepaid rates. Prepaid rates at the beginning of the period. Any prepayment is an asset at the beginning, which is 90. And then we have bank balance. This one is bank, which is 810. Bank loan, that is a liability. Trade payable, that is a liability. Accrued power. So can somebody add these ones? And then here those are the assets at the beginning. So these are assets at the beginning of the period. So we can write the assets. Then we have liabilities. at the beginning of the period. Liabilities, the first one is bank loan, which is 6,000. And then we have accounts payable trade payables, which is 1,350. Then we have accrued power, which is 150. Can we add this one? Can we add them? Add them very fast. How much do you get? So 18. So this one is 18,000. And the other one? 75. So this one is 7,500. Then here we get what we call capital. How difficult is that to do? Ngapi? 10,000? 10,500. So that one will be our capital. Write very fast. Nani hajaandika hiyo? Andika very fast. Tunaenda pamoja. Write very fast and accurately. Write very fast. You're going one step by step. Amen. So we go to working number 2. We open the bank account. We open the bank account. I hope you're following. We come here, bank account. We said mostly we must open the bank account. So now bank account, we pick the opening balance. We have the bank account there, that is 2. So we have the balance brought down for bank, which is how much? 810. And then here we have been given the closing balance. Balance carried down is how much? 378.15. Then we identify on 1st June, note number 1, addition of number 1 doesn't affect bank. Note number 2, during the year ended at 1st March 2016, total purchases amounted to 126.6 million and sales they want to credit so they don't go through the bank. And then number 3, discount allowed, discount received, those they don't go through the bank. A data owing, that one does not go to the bank. Samson Kimweta, during the year, Samson Kimweta purchased a new equipment at a cost of how much? Through check, isn't it? So here we have equipment. He purchased a new equipment at how much? 300,000, isn't it? So you write here 3. So you credit this one and debit equipment, isn't it? The following expenses were paid by check during the year. So we have interest on loan. How much is it? 450. And then we have salaries. Salaries, how much is it? 18,105, isn't it? Then we have rates, insurance and power. Rates, insurance, and power. How much is it? 11,640. Is it so? We are through the number 8. On 30th September 2015, Samson Kimwatu repaid part of the loan by issuing a check of how much?
So we have here loan. How much? 3 million. And number 9, Samson Kimwatu did not maintain. So those are the items that went through the bank account. Do we have any other? And then now, but before that, before we close that one, just a minute. We come here and open the normal account, which is the debtors account. So debtors account balance brought down is how much? Balance brought down for debtors 2,700. Umeona? Balance carried down ilikuwa ngapi?
Information number 1. We have discount allowed. It is credited to this account. How much is it? 480,000, isn't it? And number 4, a debtor owing 120 was declared. That is bad debts. How much is it? 120. Kuna kitu ingine? So nilikuambia, I told you, ukipewa hapa, if you're given the credit sales na hii, hiyo figure ingine ni nini? Ni pesa ilipo kwa nini? Kwa bank. Ukipewa hii credit sales na upewe closing balance. So the balancing figure is the amount paid to the bank. Tulisizana hivyo. If you're given the credit sales and the closing figure, the balancing figure will be the bank. So andika hivyo. Can you get the balancing figure there very fast? Can I use this calculator? So we have 2,700 plus 180,000, which is 182,700. So minus 480, minus 120, minus 36. So this bank is 178,500. Sijui kama mmepata kama mimi. Eh? 178,500. So here we post here to the bank. We say here debtors or 178,500. Working number 4, we open the creditors account. Creditors account or the trade payables. So we pick the balance board down. How much is it? Balance board down. 1350. Balance carried down 1,500. And then we go to additional information. We have 126,600, isn't it? So here said here credit purchases. Which note is that? Note number 2, which is 126? 126,600, isn't it? Then we have note number 3, discount. Discount received, how much is it? 450, isn't it? We don't have any other thing. We don't have any other thing. So we told you if you're given this one and this one. So they want you to get what? Amount that was paid as bank. Tumeelewana? So unakuja unaandika pale 1350 plus 126 600. So inakuja ngapi? 127 950 minus 450 minus 1500. So you get 126,000. So you write here creditors. Creditors 126,000. I hope andika haraka haraka na unauliza swali kama if you're not following, ask. Today I've allowed you to write together. So that is debtors. In case you have any question, you ask. Anything that is not clear. According to me, this one is more or less the same. Now we come back to the bank account. The bank account we had been told, we go back to the bank account. So the information we have on the bank account is additional information number 9. Samson Kimwatu did not maintain records of cash withdrawn from the bank for personal use. Hence, any deficit in the bank account is due to personal drawings. What it means, we are going to balance. We are going to see the inflows. These are the inflows. And then we deduct, these are the outflows. We check whether it's leading us to this closing balance. In case it's not leading us to that closing balance, then the difference is the drawings. So these are the amount of money he received through bank. And then we are going to deduct whatever it is that he spent out through bank. And we see whether it is leading us to this balance here. This is the balance that you're having in the bank. So we're going to add 810 plus 178, 500. So the total receipts he received 179, 310 through bank. And then he spent 300 plus 450 plus 18, 105 plus 11, 640 plus 3,000 plus 126,000. So he spent 159, 495. So he's supposed to have a balance of 179, 310 minus the answer. So he's supposed to have a balance of 19,815. But they're telling us he has a balance of how much? 78. So the deficit is drawings. So the difference between 78.15 and that balance. So that is 12. So drawings here, right here, drawings 12,000, the balancing figure. Tumeelewana? 179,310. 179,310. Aya, maliza kuandika hiyo. Nani hajaandika mpaka hapo? Andika hivyo. Unaandika na unasikia. Yaani una multitask, eh? Unaandika. So now we're going to prepare Samson Kimwetu. We're going to write here Samson Kimwatu. Samson Kimwatu. Income statement. Income statement. Income statement for the year ended. For the year ended 31st March 2016. 31st March 2016. And then we underline. So we have shillings here and thousands. Same heart here, shillings and thousands. So we have the sales figure. So the sales figure is the debtors account had sales, which is 180,000. So 180,000. This one. It won't, and then we less cost of sales. Cost of sales. So we have the opening stock. The opening stock, we had been given the question, it is 1,800. You've seen it? And then you add purchases. You add purchases. The figure for purchases is this one, 126,600. 126,600. And then you less closing stock, which you don't have. Closing, we need to find the closing stock here. We don't have. But we can get the gross profit here. You can get the gross profit. So we had been told in the question note number 5, Samson Kimwetu makes a uniform gross profit to cost of sales. So we've been given the markup. Gross profit to cost of sales, that is markup. Gross profit to sales, that is margin. So markup is how much? 3/7. Tumeelewana? So how do I know it's markup? Markup is profit on cost of sales. They have told us it's gross profit to cost of sales. So markup rhymes with cost of sales, and we can't be able to find the cost of sales. We don't have the enough ingredients to. So if you want to get the gross profit, if we want to get the gross profit, and we have markup, we must have cost of sales, and we don't have the cost of sales. But there's a way you can convert markup to margin so that you apply to sales and you get your cost of sales, isn't it? So now, how do you convert markup to margin? You take the numerator, you add to the denominator. You take this one plus here. Sawa. So inakuja 3 out of 10. So our GP is going to be 3 out of 10 times 180,000. How much is that? 3 out of 10 times 180,000. How much is that? Eh? 50, eh? 54, 24. 24,000. Wewe utumie calculator yako. 54. 54,000. Ini 54,000, si ndio? Kumbuka tulisema GP is equals to sales minus cost of, so sales tuko nayo hapa, so una minus hii utapata cost of sales. Chukua hii minus hii utapata cost of sales. Utakuja ngapi? Take the sales minus GP. What do you get? 126,000. 180,000 minus 54,000. Eh? 126,000. 26 or 126? 126, isn't it? So when you add these two values, minus this, you get the closing stock. Add this plus this minus this, you get the closing stock. Can you do that one? Add hii na minus hii utapata hii. Tulisema unafanya hivi ama? Unapata ngapi? Unachukua muda mrefu na calculator. Kwani you just press figures. 1800 plus 126,600 minus the other one, 126,000. So the closing stock is 24. That is the closing stock. Sawa. Eh? Sawa. So now we have the gross profit and we have the closing stock. So that is the easiest way to find it. Then now we list our expenses. We list our expenses. So how do we list our expenses? We list our expenses there. We have other incomes like discount received. So we add here discount received. Discount received. What is the value for discount received? We still have it here. Discount received was how much? 450. So you add here 450. Then you list your expenses. You list your expenses. So where do we get the expenses? We go to the, so first of all, we start with discount allowed. You can start with discount allowed. So what is the value for discount allowed? 480. And then we have bad dates. Bad dates how much? 120. Isn't it? Bad date is 120. Then we can come here, we can start with salaries here. It's very easy. Salaries do not have any adjustment, 18,105, this one. Then we have rates, insurance, and power. This one has some adjustments. So the amount of money that is paid is how much? 11,640. And then we have do we have prepaid rate at the beginning? We have prepaid rates, isn't it? 90. At the beginning, we add. At the beginning, at the end, we have prepaid rate at the end. 120. We subtract 120. So these expenses are lumped together. We also have accrued power at the beginning. At the beginning, we subtract 150, this one. And then at the end, accrued power is how much? Accrued power at the end is how much? 200 and, so we add 240. Sijui kama tunapatana hapo. Kama uelewi kitu niulize. So this is the total cost for rates, insurance, and power that was paid through bank. This one is here. And then we had prepaid rates at the beginning. Because they are lumped together, you add. Prepayment at the beginning, you add. At the end, you subtract. Accruals at the beginning, you subtract, you add at the end. What do you get faster? Unapata ngapi? Eh? Eh? 11,700. Any other figure? Then we have interest on loan interest. We have interest on loan. Interest on interest. So the interest was at the rate of 15%. So it will be 15% times the loan was how much? The loan was 6,000 at the beginning of the year. Then it's 6 out of 12 plus 15% times, it was paid half times 3,000. times 6 out of 12, just like the other question. So they had a loan and they repaid a half of it half yearly. We have been told in the question. So it will be 15, 6,000, 6 out of 12 plus 15, 3,000, 6 out of 12. So what do you get? Unapata ngapi? So loan interest, we have 0.15 times 6,000 times 0.5 plus 0.15 times 3,000 times 0.5. So that one will give you 675. So this one will give you 675. 675. That is loan interest. Then we have depreciation equipment. We have depreciation equipment. So equipment at the beginning, we had 2,400. This one, where is it? 2,400. So you take this to 2,400, and then plus the one that they acquired during the year, which was 3,000. Was it 300 or 3,000? 300. So you add this one, and then you minus the closing balance is 19. You minus 1920, you get the depreciation. This is the value at the beginning plus what they acquired, but you are being told they have 1920 at the end. So that one will give you depreciation. How much will that be? How much will that be? So we have 2,700. 27, 700 and, so this one will be 780. The same thing will happen to motor vehicle, depreciation motor vehicle. Depreciation of motor vehicle, we had 3,000 at the beginning. Where is it? This one. And the closing balance is how much? The closing balance is there, 22 feet. So the balance is how much? So this one will be 750. Then we also have furniture and fittings. Depreciation furniture and fittings. So the opening balance is how much? 1,200, and the closing balance is 960. So how much is it? Say yes. What does it say? Oh, that one, wait for it. I'll just tell you. Tutafanya hiyo, just a minute. Sawa. So that one, we have exhausted all the expenses, unless there's another one that we are forgetting. Unile forget. So you write as I do calculation. So we have 480 plus 120 plus 18, 105 plus 11,700 plus 675 plus 780 plus 750 plus 240. So that one will get 32,850. I'm getting 32,850. 32,850. Then now we have 54,000 plus 450 minus that answer. So 21,600 is the profit. So write very fast, net profit. $21,600. That is the net profit. So we come here and prepare the statement of financial position. So right here, Samson Kimwatu. So Samson Kimwatu. Statement of financial position as at 31st March 2016. And then we underline. So we have non-current assets. Non-current assets. Non-current assets. So we have non-current assets there. So the first one is freehold lands. So when you revalue land upwardly, to revalue means you have your land, for example, your building. This is your building. I want you to understand what it means by revaluation. To revalue means there is what we call the book value of that particular asset. the value at which the business is attached to that particular asset in their books. For example, you can have a land or a building, according to the books of it is 10 million, that is 10,000. But you call in expert to revalue, to give it the true market value. The expert tell you because of so many other factors, the market value is supposed to be 15 million. So that now if you sell that land, you're supposed to sell it at 15 million, not the very value that you have attached to it. So in other words, you have gained how much? Extra how much? That 5,000 is called revaluation. So how do you treat revaluation? Revaluation is like extra capital in business. So you debit the asset to bring it to the market value, and you credit revaluation reserve as capital. That is how you do revaluation. So you debit the asset by 5,000 to make it match with the market value. And then the extra 5 you credit revaluation reserve. It's like extra money you're injecting into the business. So that is how we treat revaluation. So now here, are we together? So we had freehold land. Freehold land. What was the value at the beginning? What was the value of the land at the beginning? 6,000, isn't it? Then note number 1, they are saying they revalued it to how much? 2 million, isn't it? Revalued upwardly by 2 million. So it's supposed to be 8,000. See, that is revaluation. Then furniture, we just take the value that we have furniture, we take the value that we have been given at the end, 960. Motor vehicle, you just take the value that you are beginning at the end. Motor vehicle, the value that is given at the end is how much? 2250. And we have equipment. The closing value is how much? 1920. Then we list the current assets here. We list the current assets. Current assets, we have the inventory. We had done you start with the inventory always, which was 2004. That one, it is there. And then we have trade receivables. Trade receivables, we still have the balance here. It is here, 3,600. So trade receivables, which is 3,600. Then we have prepaid rates. What was the value for prepaid rates? Closing. Prepaid rates at the end. I think we still have it here. It is how much? Prepaid rates. Where is it? It was, is it 150? Prepaid rate was 120. Then we have bank balance. This one 78. This one 7815. 7815. So those are the only assets we have. So you add them here. Then here we have capital and liabilities. Capital and liabilities. So capital, how much is it? Capital. We have done capital, it's 10,500. Then you add the net profit. Net profit is how much? 21. And then we add revaluation reserve. Revaluation reserve, which was 2,000. And then you less drawings. Drawings was how much? 12,000. So you less 12,000. Then here you add non-current liabilities. Non-current liabilities. Non-current liabilities. So we have bank loan. It was 6,000. 3,000 was repaid. So it is remaining. Then here we have current liabilities. Current liabilities. What do we have? Current liabilities, we have trade payables or account payables. Trade payables is how much? Closing balance is 1,500. This one. Then we have accrued So the bank interest that was paid was how much? It paid an interest of how much? 450. So 450. So accrued interest. Accrued interest how much? 450 minus 675. The total interest is supposed to be 675, but they paid 450. So the accrual is how much? 675 is what's supposed to have been paid throughout the year, but they only paid, so 225 is still accruing. So you write here 225. And then we have accrued power. Accrued power is how much? Accrued power. How much is it? 240. 240. Then you see whether they agree. So that is how, can we see whether they agree? So we add 8,000 plus 960. It is agreeing. It is how much? 270. This other one. So that is how we do those questions. You have the easiest question to be done, those ones in complete record. So now assignment. You do assignment. This one you attempt at home. In case you attempt before class time on Saturday, you can always bring it over so that we can check together before class time. If you do this one successfully, there will be no need for us to do extra questions. So you can check May 2019. Is it May 20? No, just a minute. November 2019, question number 2. 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 And then we also have, I think May 2019 also. May 2019, question number, so we had 2 questions that sitting, but I want you to do the last one. That is question number 5. May 2019, question number 5. May 2019, question number 5. Attempt those 2. Attempt those 2. So that will bring, today, that will bring us to the end of our class today until on Saturday. Yes.
Zima mic.